Hello friends. Today we'll discuss one topic which has been in news recently regarding risk weights of personal loans and credit cards. So, from prelims perspective, the topic is important. We need to understand what are risk weights, what are the Basel norms regarding this, and what are the provisioning requirements for the bank loans. Now, first, let us understand the news first. So, recently RBI announced that risk weights on the following category of loans have to be increased. Those loans are unsecured personal loans, consumer durable loans, and credit cards. And it is applicable both to outstanding and new loans. And this risk weights have microfinance loans by NBFCs have been exempted from this provision. So, with this perspective, we need to understand what are risk-weighted assets from banks' point of view and how they will affect the functioning of banks and the credit in terms of consumable and credit card flow of credit. So, let's see. First understand what is risk weight. Now, to understand risk weight, first let's have a rough idea of how the bank's balance sheet looks like. Now, if this is the balance sheet of the bank, we have the liabilities here and assets here. Okay. So, whatever the consumers deposit in bank, let's say savings of fixed deposit will come under liability, and you will have the bank's own capital. So, this will be the source of funding for bank, and whatever the loans which banks advance to its consumer, be it home loan, business loan, or credit card loan, will be the assets of the bank. This will be primarily how basically a bank will function. Okay. Now, once we have the idea of bank's balance sheet, we need to understand that whenever banks give loans to consumer, they have to keep certain provisioning for if a loan becomes bad or it becomes an NPA. What does it mean when loan becomes a bad? Its recovery is not guaranteed, or the borrower is not in the condition to repay it to the bank. Now, bank has to write off those loans. Now, to have certain what is a safeguard, the banks are required to make certain provision based on the outstanding loan amount. Now, the provision is not to be made on outstanding loan amount, but we need to multiply those with risk weights, and we come at something called risk weighted assets. And on that risk weighted assets, the banks are required to make provision as per RBI guidelines. Now, see, let's see an example. Every loan which is given by bank is accorded risk weights based on risk perception of each asset. For example, house loan or a mortgage which is safeguarded or secured by a property will have less risk weight, because a bank can always take the possession of the asset if the loan goes bad. But in case of credit card, it is an unsecured loan. There is no security given by the borrower. So those credit card loans will have higher risk weights. So based on the total risk weights, total risk weighted assets are calculated, and then that risk weighted assets is used for determining the provision. So with this example, it will be more clear to you. Suppose a bank has given a consumer loan of 1 lakh and credit card loan of 1 lakh. So total loan given by banks are 2 lakh. Now, old risk weights given by RBI for consumer loan were 100%, for credit card loan were 125%. So as per old risk weights, the risk weighted assets would be 1 lakh for consumer loan, 1.25 lakh for credit card loan. So total 2.25 lakhs. Now, the RBI has increased the risk weights of this too. From 100%, it has become 125%. So now risk-weighted assets will increase from 1 lakh to 1.25 lakh. Similarly, for credit card, old risk weights are 125%, new risk weights are 150%. So risk-weighted assets have increased from 1.25 lakhs to 1.5 lakhs. So now the total risk-weighted assets of banks are 2.75 lakhs. Earlier, the banks were required to make provision on this. Say, suppose 10% they are making provision. So it comes to 22,500. Now the banks will be required to make provision on this. It will come to 27,500. So now this says that the provisioning of bank has increased, which indirectly means the cost of banks have increased. Now how it will impact? Let's see how it will impact the loans. Now, firstly, as we have seen in the previous slide, the cost will increase because banks will have to make more provision now because the risk weights have increased. Now, this increase in cost will be transferred to consumer, and the rate of borrowing may increase for the end customer. So, borrowing cost for consumers will increase. Now, indirectly, the RBI wants to slow down the prevalence of unsecured loans. Once the cost will increase, there will be less consumers willing to take such loans. So, indirectly, RBI is trying to reduce the prevalence of unsecured loans in market. Now, one more impact will be increase in capital requirement. Now, to understand this, let's first understand what are Basel norms. So, Basel norms are issued by an international organization, which is nothing but a society of central bank governors around the world. Now they come and they have come up with certain standards which a bank should follow to ensure that the bank doesn't go to a bank run or a default. So those are certain minimum capital requirements a bank should have. So, for example, 9% is the current rate which is followed by RBI. The capital to risk weighted assets ratio should be 9%. So, for example, if 100% is 100 rupees is the risk weighted assets, at least 9 rupees from this should be bank's own capital. Balance 81 can come from the deposits from consumers, but at least 9 should be from bank's own capital. Now, since we have seen that risk-weighted assets, risk weights have been increased, so this risk-weighted assets will also increase. So, say for example, to 125, this will mean that now bank have to increase their own capital also. So that will be the, that is the meaning of increase in capital requirement because of increasing risk weights. Now let's see what are the Basel norms. This is important with regards to prelims. Now these are international banking regulation issued by Basel Committee on Banking Supervision. Basel is a place in Switzerland, and where this committee is established, that's why these are called Basel norms. Now the members of this committee are all the central bank governors. Like from India, it will be RBI governor will be the member of this committee. They have given certain international standards so to prevent the cases of bank defaults. Now currently, Basel 3 norms are in place. Basel 1 had come in 1992 and Basel 2 had come in 2009. Currently, Basel 3 norm is being implemented now in phased manner. So, these are some important terms which are covered in Basel 3 norms. One is, which we have seen is capital to risk weighted ratio, CRAR. Then there is something called capital conservation buffer, counter cyclic capital buffer, leverage ratio. Now, we don't need to get into extremely technical details of all this, but we should know the terms are related to something called Basel norms. Okay. Now, that's with regards to this topic. Let's see one practice question which has been asked in prelims 2016. What is the objective of Basel 3 norms? Develop national strategies for biological diversity, reduce greenhouse gas emissions, transfer technology from developed countries to replace chlorofluorocarbons in refrigeration, or improve banking sector's ability to deal with financial and economic stress and improve risk management. That's what is Basel norms. So answer will be D. So this concludes our topic on risk-weighted assets. Thank you.